Hello, with this case study update from the Trade Desk, I'm Jeffrey Beamer. Today we're looking at our Intel calendar spread. The stock has made a move here a couple of days before our short option expires, so we need to make an adjustment. So let's dive right into it and take a look at at what's going on here. You'll see from the chart here that Intel has made a little bit of a move down. It was trading nicely at our really our maximum profit level, which is the $35 level. But today it's moved down dramatically, about 40 cents for Intel, and that puts our short puts in the money. Our short puts, that's fine. While that's fine for our long trade, it's not so good for our short position. So here's what we're going to have to do. Our short position, we're going to need to what's called roll that position, and we're going to roll it out in time just a little bit. So let me walk you through the steps. We originally bought the Intel September 35 strike put. Okay, that was priced at around $1.21 when we initiated the trade. To help reduce the cost of that, and because we thought the stock was going to just kind of go sideways for a bit, we sold to open the August week number 2 35 strike put for 82 cents, and that reduced our cost basis significantly. All right. Well, now the stock has dropped a little bit. Our 35 strike puts are in the money. They do expire in 2 days, so we need to go ahead and make that adjustment. Here are the steps behind the adjustment. It's pretty simple. We're going to do another calendar spread, except this one is in reverse. And what I mean by reverse is when we typically initiate a calendar spread, we buy a longer term leg and we sell a shorter term leg. This time we're going to do the reverse. Okay, we're going to buy the shorter term leg. In this case, we're going to buy to close the Intel week number 2 35 strike put, and we're going to sell to open the Intel August week number 4 35 strike put. Now your broker is going to have no problem with you doing this because you already own this September piece of property, so to speak. All right, so they already can see that you have a hedge, or you have an offsetting position on the books. So they have no problem with you buying something to close and then selling this other leg, which expires August week number 4. Now here's a couple of neat things about this trade and why we are doing this adjustment. When we originally sold this 35 strike put for about 82 cents, we can now buy that back, even though it's in the money, for about a 30-cent profit at 52 cents. That 32-cent profit we're going to lock in, and then we're going to sell the next leg, the week number 4 35 strike put, for 76 cents. All right, so we're going to buy to close the week number 2 for 52 cents, sell to open the week number 4 for 76 cents. That's a 24-cent credit, okay? And that credit will be reflected down here on our cost basis. Now remember, the overall entry debit to this position was 39 cents when we started this case study back at the end of July. Now, with this adjustment, we're able to reduce our cost basis down to 15 cents and still enjoy a very nice rate of return potential and overall profit potential. And you can see the maximum profit versus risk number is still very, very nice. All right. So once we do that, this risk graph here is reflecting the adjusted position. You'll see that our break evens here, the two gray lines, they've widened out a little bit, which gives us more room for the stock to oscillate around. But my anticipation is that the stock is just going to stay in this range and just kind of oscillate around a little bit, okay, into our profit zone. That's our prognosis. Now, let's take a look at implied volatility and see where we stand with it. Notice up here that we have a positive vega of $1.57. Let's put that into perspective. If we go down here to our volatility chart, we see that we have had a drop in implied volatility. It is actually trading at longer term lows. That's the bad news. A drop in implied volatility works against us when we're in a calendar spread. But here's the good news. The good news is with this move down, volatility has ticked back up. And I would be safe to say that implied volatility, its average, if I took all these gyrations and smoothed them out into an average, I would say it's right around the 21 level. And we're down at 17. So if we revert back to the mean, which is what happens when you stretch out something from highs to lows, it will snap back to the middle like a rubber band. This move will actually benefit us. And it's kind of interesting to look and see how that will impact us, and our Vega risk will tell us what that impact is. So if we look at our Vega risk of $1.57 and we assume that implied volatility is going to move from 17 back up to 21, so it's going to move 4 points. That 4 percentage points times $1.57 is $6.28. Now that's per spread that you do. So if you did 10, okay, then you just multiply that times the number of contracts. The bottom line is a move up with one contract would mean $6.21, or excuse me, $6.28 to us. That is to our profit. That's just from a change in implied volatility. Of course, 10 contracts would be $60. That's how that works. So overall, this adjustment, okay, we modeled the adjustment and it looks like a good adjustment that's going to help us stay with our prognosis, increase our probability of success because it widened out our break evens, and still give us a good opportunity for a nice return on investment. With those criteria met, we're going to go ahead and make this trade. So once again, in closure, we are doing nothing with our long position. This Intel 35 strike put, it just stays the same. All we're doing here is we're going to buy to close the August week number 2 35 strike put, and we're going to sell to open the week number 4 35 strike put. Now you'll see, in conclusion, how I've colored these. Our active position that we own is in green, our obligation is in red, and then positions that are no longer active are going to be kind of what I call grayed out, but in this case the color is brown. The colors will always match. There might be some light blues or light pinks, or you'll see in the future, but you'll notice that these two brown legs here are just offsetting positions. That's all it is. So I hope you found this case study update of value. Counter spreads are one of my favorite positions. I do enjoy trading them, especially in low implied volatility environments like we have right now. So that's our case study update for today. I'm Jeffrey Beamer. Thanks for listening.